Lyft shares are moving higher in the after hours since reporting its first quarterly earnings. The conference call is underway as we speak. Deirdre Bosa joins us now with all the details. Hi, Deirdre.
Hey, Melissa. Well, the analyst Q&A just kicked off, and that first question was around Lyft's addressable market. The analysts wanted to know about ride-sharing versus the choice of owning a car and any trends that the co-founders have seen. John Zimmer, one of the co-founders, answered by calling Lyft much more than a ride-sharing company. He said that they're going after, in the U.S. alone, the consumer transportation market that's worth $1.2 trillion, calling it a once-in-a-generation opportunity. He also highlighted the areas that they see as driving growth. Have a listen.
I want to highlight 3 areas of execution that are helping us grow fast at scale. 1, we are singularly focused on transportation. 2, we are investing in our driver community. And 3, we are successfully executing on our enterprise strategy we call Lyft Business. It is our singular focus on consumer transportation that has allowed us to go deep and build competitive advantages along the full stack of offerings.
Now, this is their execution in their addressable market, but their quarterly numbers that we got tell us that Lyft is actually paying more for that innovation and execution while growth is slowing in Q1 total costs and expenses. They jumped more than 200% as Lyft continues to spend to compete with Uber. And Melissa, the second question, which I just sort of heard the quick response to, asked about that path to profitability, what I think everyone is wondering about these ride-sharing companies. And they spoke about the contribution margin, which is a gauge of their efficiency, business efficiency, which did improve on the quarter. Melissa?
All right, Deirdre, thank you. Deirdre Bosa. Where do we go on Lyft here, Dan? I feel like there is enough for both the bulls and the bears in this report to really latch on to.
Yeah, I mean, the fact that the stock is down a couple percent, now it's up a couple
that's
percent.
Just it. I mean, if you're really good, this is high dynamite stuff. It should be up 10, 12. Yeah. That's all it's got?
I don't know.
That's all it's got?
Listen, I think the most important headline, if you're just reading the headlines, you're not listening to the call, is that 2019 is going to be the peak loss year, okay? And really, I think what's most important is not a whole heck of a lot has changed since the company did their IPO roadshow in March, and that's the good thing. The other good thing is that we know that these operators, Zimmer and Green, the founders of this company, they're very focused. What did we just hear them say? They are a pure play on the ride share business. So as Uber's coming out, they have this roadshow going on. We don't hear a whole heck of a lot about it, but you're telling me that that roadshow is going better than the Lyft roadshow, and this stock is down $12 from when it, from its IPO price. If we were playing Would You Rather here, would you rather buy this one where it's pretty well vetted after the last nearly 2 months at $60, down 12% or $12 from its IPO price, or are you going to go in there and pay $80-90 billion for Uber right now? It's a pretty easy one for me.
Why do you need to buy either?
Yeah,
Why
exactly.
would you? I mean,
Okay,
I wouldn't rather either of them.
But haven't we?
I'm okay with the would you rather, by the way, but you would neither.
I just don't know why you need to be into either one. I mean, yes, I agree. If I had to be in one, this would be the one that I would be in. But I mean, I don't get the whole space. I don't.
Really? You never use them? It hasn't displaced a lot of like your taxi rides, your own car ride.
Just
I mean, it's probably one of the most.
Displaces something doesn't mean that the stock is a good buy.
The problem is with growth slowing and costs going higher, and these guys saying that they're going to get to a point where they're going to stop losing money at this kind of a rate. How does that happen? When we all know that the costs going in, the operating costs, as well as the insurance, all of that, how are they going to execute on that? And that's the answer we've not heard yet.
For more on Lyft, let's bring in Loup Ventures founder and Fast Money friend Gene Munster. Gene, you heard our discussion. I usually ask you for the grade on the quarter last, but in this instance, I would like you to grade the quarter first because I want to understand where you're coming from.
Let me preface that, Melissa, with I started when I saw the results with a B. I bumped it up to a B+ based on a couple comments on the conference call. So B+ is the answer.
Okay, and why is that? Why did you bump it up? What'd you hear?
2 things. Number one is this idea about that 2019 is going to be the biggest loss year. This is important because Lyft is going through a big transition. No investor owns Lyft because this is going to have a driver network, humans driving other people around. It's because autonomy is the future. But that is such a big goal, such a big investment. Their R&D was up 10x year over year. That makes investors nervous about how long that investment phase is going to go on. The fact that they said that they will be the peak year in 2019 is important. And keep in mind, too, this team is a high integrity, high ethical team. And I think a lot of investors don't really appreciate that part of the story. But I trust them when they say that this will, in fact, be their biggest loss year. Not to say that they're going to be profitable in 2020 or 2021, but just a move in the right direction. That was one reason. The second reason, Melissa, was this comment about a partnership. They're going to have 10 vehicles, just 10, in the Phoenix area at the end of Q3 that are going to be fully autonomous. So this is really important because the biggest competitor to Uber and Lyft longer term is Google. And the reason is that when you go and move around, if you're doing a ride share, you pick Lyft or Uber. And if you're driving yourself, you open up Waze or Google Maps. Google Maps is a huge top of the funnel. More than 1 billion people per month use that. And ultimately, Google is either going to displace Lyft and Uber over the long term or partner. And the fact that Google is only partnering through Waymo with Lyft is a huge competitive advantage I think is underestimated by the street.
Right. Gene, a lot of people are focusing on this path to profitability, so to speak. Should investors who are in Lyft today care about a path to profitability? Can it still be a good stock to own, a trade, if you will, without a path to profitability right now?
No, it should not be a
So then what is the
stock.
path to profitability? Because that's the big question that's here on the desk at least. And you talk to analysts, a lot of people say, oh, they're going to leverage their network better, they're going to gain efficiencies. What network do they have if they don't own the cars, they don't own the drivers? What is that network that they're leveraging?
Well, in their case, they've got 20 million monthly active users, which is, call it, compared to Uber at 90 million global. So it's a much bigger number, more concentrated in the U.S. So that's what they do have. They have a user base. That's important. I think most tech companies can be relatively easily replicated, but having a brand and some users around that, I think, is critically important. To be able to plug that into another platform like Waymo, I think, is a material competitive advantage. And let me just one more thought on this trading concept is I think this is going to be a difficult one to trade for the next few quarters. I think that ultimately this is one of those, do you believe that the future is a ride-sharing future and transportation as a service? If you believe that, then Lyft is going to be one of the winners. But to get there, it's still, despite the positive comments about the track to profitability, it's going to be a long road.
Last quick question, Gene, and I hadn't thought about a network that they own as the passengers, as the user base. Do we have an understanding of how much that user base overlaps with Uber's user base?
We do. It's about 85%. It's a huge overlap between the two. Most people just simply check between the two.
Right.
I think that is going to keep going on for a long time. But again, this longer term play, this is why it's tough to trade over the next few quarters. But longer term, the company that partners with the best hardware around autonomy is going to be the winner.
Gene, thank you. Always great to speak with you. Gene Munster of Loup Ventures, who gives the quarter a B+. Have any minds been changed? Karen, I'll go to you first.
No, I mean, good for them. B+. Okay. I know you would be sadly just,
I'd be like,
Crush it.
Mel would be
crushed. Yeah, Mel wouldn't be able to recover from that. But I just don't get it. And it's a competitive industry, and now you got their biggest competitors about to have a ton more money. I just don't get it.
You sound like people sounded about Amazon in 1997. How is this company ever be profitable? How are they going up against all these big retailers?
They ultimately did make money.
Screaming at the
right.
Took a long time.
Took a long time.
Okay, but I'll just say this. As we think about technology, we talk about like some boring semi companies, the OEMs, or this and that, whatever. Here's a technology company that is actually going after, just a massive technological shift, the way we all live. I think we could probably give them a little room. Let's let them get out of 2019, both of them for that matter. I mean,
So does that mean you don't own them? You don't trade them in 2019?
No, but I mean, listen, I'm just saying, I wouldn't have been buying Lyft at $87 the day of the IPO, but here it is at $60. And so I just don't think the story should be damned. It's one of the most interesting technological stories that we've had in the last. It's a lot more interesting than ephemeral messaging, mobile messaging, and stuff like that. That's ad supported, don't you think?
I think you get a shot at $45 a share. So
okay, maybe. I don't know.
It's a prediction.